Treasury yields ticking lower with the 10-year and 2-year getting closer to inversion. Joining us now, Priya Misra. She's global head of rate strategy at TD Securities. Jack Caffrey, equity portfolio manager at JP Morgan Private Bank. And Matt Miskin is co-chief investment strategist at John Hancock Investment Management. Priya, where were you sitting like 10 minutes? Were you near TV? I was talking about you.
Oh, thank you.
Were your ears burning?
I didn't hear that.
So you have a recession model, and you point out it's at 55%, but it's based on the yield curve.
It is, yes.
So it's not purely on the yield curve. You're at 55%. Do you take anything else into account, or is that fully what your recession forecast is based on?
So we have multiple models. We have an economic model, so that's based on initial jobless claims, etc. Then we've got a yield curve model. I have to say, if there's one single market indicator that you can look at to predict the recession, it should be the yield curve. I've been getting this pushback that essentially the yield curve is inverted because global yields are low. So, it's not that good an indicator. I would actually argue it is a very good indicator because, as Chair Powell's told us, global growth is weak. That's actually forcing the Fed to ease. I would argue the Fed has gone from being all this preemptive to now potentially behind the curve. The curve is essentially bull flattening. So the long end is telling you the Fed's not doing enough. So if the Fed here does not come in and say we're going all the way to zero if need be, I think essentially the market's telling you that the Fed's not doing enough. So that yield curve signal, I think, is a signal of weak global growth, which we think feeds through into essentially U.S. weak growth, plus the Fed not, essentially doing enough. So I still think it's a very good indicator. It's now, the market continues to essentially bull flatten. So I reran the model this morning. It's now closer to 60%.
So are you, if you putting all that together, in the next 12 months, you expect a better than even chance that the United States enters into negative GDP, to dropping GDP?
Yes. I would say, whether it's negative, whether we're officially in a recession requires 2 quarters of negative. Right. But if you're below potential, so our forecast for GDP next year is below potential. Because we just find it very hard to see how global growth can be this weak and the U.S. can be this one island of essentially prosperity. I think we don't see any fiscal stimulus. So the fact that business investment is weak, that's the first sign that global growth is having an impact on the U.S. The consumer is probably next.
Okay, Matt, you're nodding at all that. You have to decide what to do. All that put together, and you come up with quality growth stocks. Is that what you should do with that backdrop?
That's our core. So high return on equity, good balance sheets. Focusing on the balance sheets within the United States is your best opportunities. The way that we're doing that, though, is we're barbelling it with infrastructure equities. This is an undercovered asset class that we think is going to gain a lot of traction in the next 12 months, given the backdrop that Priya just outlined.
Well, you agree with that there is going to be a recession in the next 12 months, or 60% chance? Are you in that camp?
So we look at the leading economic indicators from the Conference Board, which also includes the yield curve. That is probably going to go negative in the next 3 months. It's at about 1.5% year over year. If it continues the current trend, it goes negative. Typically, on average, a recession starts 5 months after it goes negative.
Jack,
so,
okay.
Again, it's a similar outlook, but it's what you do now. Duration on fixed income, high quality within equities in the U.S. is still the best game in town.
I don't want to put words in your mouth, Jack, but you
go ahead.
Okay, but you, as a rule, thought that growth was going to be slow this year anyway, yep, and that stocks might not do as well as they've done, but the Fed has changed that dynamic for you, and valuations remained high.
Valuations went from very average to high, and over the past month, they have come back to a richer than fair. But I think relative to the cost of capital, relative to the hurdle rate that we now get from the fixed income markets, stocks are more reasonably valued. And I do think that we can think that there's a trade-off. When you think of hurdle rates would suggest $1 of earnings are more valuable in this low growth world, that equities are for you growing income. We think that's more valuable, but you have to balance that a bit with this idea that interest rates decline because of uncertainty about what the ability to generate $1 of earnings will be. Now, I think the Fed has shifted from being really the price setter for the world to being a price taker. And that's something very different than the experience that I've had in 30 plus years in the markets. And when I look at the U.S. economy only having about 10% of GDP tied to global growth, I think I can be a little bit more constructive on the U.S. story given it's
and
insulated.
Earnings are okay, and we're almost done with those.
Earnings. We were supposed to have an earnings recession. It looks like we're actually going to have a little, very modest, but still some earnings gains year on year when all is said and done.
After all this, one of the quotes in your note is that your year-end view is not really affected at this point. But I couldn't find your year-end view anywhere. What's your year? Do you have an S&P year-end view?
I do not have a number. But I entered the year thinking we'd be up 8-10%.
8 to 10%.
8 to 10%. So when we were up 20, I was wrong. I'd like to be wrong that way frequently when markets do twice as well as I thought.
What are we up now, 15 or so?
I think we're still up 15.
So then you're still...
So yeah, I feel like we're going to finish the year maybe with...
There's still a few months left in the year for your...
Yeah, I know.
Your outlook to come true.
Or to be really wrong.
Yeah.
Either way, we'll...
Well, I thought last year it'd be up 8-10. We were down 4. So,
right.
Year before that, I thought we'd be up 8-10, and we were up 22. So, I think you average that out.
You stick with that 8 to 10. It sounds like you're. They pay you for that?
They pay me for being right.
They do. All right.
Not for my S&P forecast, thankfully.
Thank you, Jack. Priya, thanks. We'll see.